You can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case in 1980 at all. So people that say you can't compare to 1980, this is not that situation, stop using those ratios, I agree. This is going to be much worse for the dollar, and it is going to be the end of it, because, so forget about the Hunt brothers, the end game is coming, it is coming soon. This period will be a lot worse for people who own dollars and a lot better for people who own gold and silver, because the gains from 1980 will be held and surpassed. And since 2024, the interest rate has been going down. They realized that if they attacked the monetary aggregates and kept them from growing too quickly, they would also be able to manage consumer prices. That's why the dollar weathered the volatility of 1980, but now, of course, the dollar is at 120% or whatever it is, but gold and silver are doing better, and so are stackers, and so is the end of the fiat monetary system. 1980 was a fantastic year for the collapse of the fiat monetary system, but it wasn't good enough because it kept going and is still running now. But this time it won't. And here's why. What are the main differences between now and 1980? Why will the dollar probably completely collapse this time when we reach 1980 conditions, even though it didn't in 1980? Okay, let's talk about that. The claim here is strong. Today's setup promises what 1980 couldn't, a currency collapse, but is the comparison really fair? The US debt to GDP ratio was less than 35% in 1980. IMF data shows that today it is around 120%. Because of that fundamental difference, rate hikes are today much riskier than they were then, but a collapse doesn't have to happen. The dollar still makes up 60% of the world's reserves, which is something that wasn't true in 1980. Investors should be careful. This framing as unavoidable doesn't take into account how strong US capital markets are, but the logic behind the debt still supports gold's long-term argument. Next, he utilizes charts to show how different 1980 and now are. So here is a chart with three colors, blue, red, and some type of yellowish, greenish, orange, or whatever that is. You can tell me later in the comments how bad I am at colors, but whatever. What can I do? My eyes are my eyes. It seems like you could be colorblind. If you're colorblind, you can't fly aircraft. It's okay, little orphan, just tell me what the emergency is. This one, which I think is the red one, shows how much prices are going up in the US. The blue one is the price of gold. It's not right. And this one over here, the unstable one, is falling down over here, and then back up. That is the US interest rate, which is the Fed funds rate. In 1980, interest rates were going up and up and up because the US inflation rate was going up, which means that prices were going up and up and up. The Fed was raising interest rates, but not quite. It shows that rates went up in 1980 as the Fed tried to keep inflation down, but charts alone don't tell the whole story. In 1980, the CPI hit 13.5%, which made Fed Chair Volcker boost rates to 20% by 1981. That amount of tightening killed the housing market and started a double-dip recession. The CPI hit a high of 9.1% in June 2022, but the Fed halted raising rates at 5.5%. The gap shows how limited today's policy is. The message is plain for investors. Gold doesn't just respond to inflation, it also responds to the Fed's incapacity to match historical firepower. Next, he explains why the cuts in 1980 weren't what they seemed to be. We'll talk about why not quite. The next slide didn't show that. This was a time when interest rates, gold prices, and the consumer price inflation rate were all going up. Then there was this time when the interest rates were dropped back down to whatever that is, maybe 5%. And then they went right back up to about 13 or 14% right here. And in a second, we'll understand exactly why this was. But as you can see here, the Fed was trying to keep consumer prices down. Not exactly consumer prices, but we'll see why they were trying to keep something else down in a minute. And while they were doing that, they finally had the US inflation rate under control. When the red line started to go down, they started to lower rates consistently over here in this greenish yellowish line, and you can see that the price of gold was also going down at the same time. Notice how he indicates that the Fed was doing more than merely combating pricing for consumers. They were going after something more important. In 1980, the rise of the money supply, not the CPI headlines, was what really determined policy. When Volcker lowered rates for a short time in 1980, the markets felt the fight was done. Then, after a few months, the Fed blasted them back down to 20%, showing how little control they had until monetary aggregates slowed down. The crash of gold that came after wasn't random. This was done through liquidity choke points. The parallel is quite important for today's investor. Don't mix up short-term rate changes with real policy goals. Then he looks at Fed transcripts to back up his position. What I'm trying to convey is that the Fed was hiking rates in 1980 and 1981 to try to stop prices from going up, and only when they reached this target and observed that the inflation rate was steadily declining did they start cutting rates on a regular basis in 1981 when consumer prices were also falling. So to put it another way, the Fed already had the inflation rate under control when they started decreasing it on a regular basis. That was the case in 1980, and that's one of the reasons the fiat monetary system didn't end that year. This isn't a chart, it's a transcript. In the explanation below, I'll provide you the URL to the precise page where you can find this stuff. It's on page 7 of the PDF. I found it on the Federal Reserve's website. This is the transcript of their policy decisions for November 18, 1980. It reminds us that the Fed only cut rates once inflation had obviously been beaten, not before. That difference is important. By the end of 1980, CPI had already reached its highest point, and unemployment was rising, approaching 10%. The minutes from the Fed's meeting on November 18th supported their belief that their policies had stopped inflation in its tracks. Now, on the other hand, Powell is openly talking about cuts, even though the CPI is still above goal and real earnings are only going up a little. This gap is huge for portfolios. It decides if easing will keep markets stable or cause another rise in inflation. Then he reads straight from the 1980 transcript to show how the Fed thinks. This is the Federal Reserve on page 7, and as I read it, you'll see why I'm telling you this. The Federal Reserve Board adds that staff analysis shows that the demand for money has been very high in the past few months due of recovery and economic activity, as well as a nominal GNP, not GDP, had been a lot bigger than expected. It was thought that transaction balances would grow much more slowly for the rest of the year. This was partly because of the lagged effect on the demand for money following the strong rise in interest rates over the past several months, and partly because the recovery in activity seemed to be slowing down. The members of the committee talked about policy for the near future, and most of them agreed that the goal should be to sharply slow down the growth of money from the fast pace of the last few months. So if we look at this chart again, we can see that they started to lower rates again in November 1980 after lowering them here. What the Fed says matters. And here they said that demand for money was high, which led to another round of tightening. Notice that they weren't reacting directly to the CPI, but to transaction balances and nominal growth that were higher than expected. This is a typical way of thinking for monetarists. If you control the flow of money, prices will follow. Compare this to today, when M2 has been getting smaller every year for the first time in decades, but consumer inflation hasn't gone down, which shows that things are changing. That discrepancy is a warning to investors not to depend only on monetary aggregates as signals. Next, he talks about why the Fed's battle in 1980 can't happen again in today's system, which is full with debt. This is the 1980s, when they started to boost interest rates again up to about 15%. What made them do that? They saw that the money aggregates were going up quicker than they wanted. The M1, M2, and M3 money supply are the monetary aggregates. This was when the Fed was really attempting to keep prices from going up too much. Inflation is the difference between the number of dollars and the amount of gold, or how much the money supply is truly growing. Inflation is the same thing as that, and they adjust the definition of vaccination to what it was before and what it is now that COVID is here. I won't go into it right now, but it's the same kind of crazy stuff that Orwell wrote about. But this was when the Fed was not really fighting inflation, it was attempting to keep it under control. This is the silent part. People on Wall Street don't say out loud. Inflation used to be defined by the Fed as the expansion of the money supply, not the rise in prices for goods and services. Volcker raised rates to almost 15% in 1980 because M1 and M2 were growing too quickly, not because the CPI went up. That difference is important. Price inflation comes after real monetary inflation. Powell says today that he depends on data, but the Fed doesn't keep track of aggregates in public the way it used to. Investors have to trade without knowing what's going on, because CPI prints are months behind. How can you know where the fire spreads if you can't measure it? Next, we'll look at how the Fed's concentration on aggregates really given them power over markets, meaning the actual money supply numbers, not how they affect prices. They didn't care. Not that they didn't care, changing the effect of consumer prices wasn't their main purpose. They recognized that if they attacked the monetary aggregates and kept them from growing too quickly, they would also be able to regulate consumer prices. They did this in the end, which is why we still have a monetary system like it was in 1980. So at this point, the Fed is raising interest rates to keep an eye on the money supply, and this chart shows us when they raised rates to the highest level, which was around early 1981 or so. Once they perceive that the money supply is growing at the rate they want, they can control the prices of gold and consumer goods over here in the red. This is a rare occasion where what people thought about money was true. First, control the amount of money in circulation, and then prices will go up. By early 1981, when Fed funds were close to 20%, the aggregates calmed down, CPI went down, while gold fell from its highest point. That sequence shows how central banks used to care more about keeping their balance sheets in order than how the market looked. Now let's look at the opposite. The Fed completely ignores changes in the money supply, even though M2 rose 40% from 2020 to 2021, the quickest rate since World War II. The repercussions on housing, commodities, and asset bubbles were all foreseeable. If you don't look at aggregates today, you can get the wrong idea about how long inflation will last. Next, we'll talk about why the 1981 playbook can't be used again because of how much debt there is. But this is not their main purpose, of course. They want to control the money supply, which will control consumer prices, which will also affect the price of gold, and then they start lowering rates once they know they can handle it. You can also see the debt to GDP ratio, which is another reason why this isn't like the 1980s. I know that GDP isn't real, however, this is still a broad number that tells you something. In 1981, when interest rates were at their highest, the debt to GDP ratio was 31.8%. This is, I suppose, the lowest it's ever been since Andrew Jackson. I might be making something sound worse than it is. I didn't check out the 1800s. I can't locate any numbers for the debt to GDP ratio in the 1800s, but you can see that this is the lowest one presently. This is exactly when gold prices were at their highest and consumer prices were at their highest. This is the math that people don't see. Debt to GDP was only 31.8% in 1981. Therefore, the Fed could raise rates a lot without putting the country in debt. Debt is now more than 120% of GDP, which means that every percentage point rise in rates adds hundreds of billions in service expenses. That's the main problem for people who want to invest for a long time. The Treasury's balance sheet, not inflation targets or unemployment. At that time, gold prices reached their highest point because the Fed could squeeze liquidity. Now, too much government spending almost guarantees higher structural inflation and longer gold support. Portfolios need to take this asymmetry into account. Next, we'll talk about why the Fed can't use rates as weapons like Volcker did. This is the reason they could raise interest rates so high because the debt was so low compared to any other year since World War II, at least before World War II, the Great Depression, and currently. That is why the dollar weathered the turmoil of 1980. But now, of course, we're at 120% or whatever it is, which is pretty close to the highest level of debt to GDP ever. They can't hike interest rates right now, so they're lowering them instead, even if costs are going up for consumers. This is the chart that shows how the US inflation rate, which I mean in quotes, not really the inflation rate, but the consumer price acceleration rate, and gold are related to each other. I don't see why it's not gold. What is that gray, green, or whatever the hell it is? The blue line shows the federal funds rate, which is the US interest rate. No one on CNBC is brave enough to say what debt is. If the debt to GDP ratio is 120%, hiking interest rates too quickly would cause Washington's own finance to fall apart. That's why cuts happen even when the CPI goes up, which is the opposite of what happened in the 1980s. The market knows this. Gold prices go up as real yields go down, and the dollar's value goes down. Powell can't do whatever it takes without causing a fiscal crisis, unlike Volcker. The illusion of choice is no longer there. Fiscal math determines monetary policy. This situation is good for hard assets and bad for cash when it comes to investing. Coming up, we'll talk about why cutting into increasing inflation makes the system worse. You can see that the US inflation rate, or the pace at which consumer prices are rising, is still around 2.5%, close to 3%, and the interest rate has been going down since 2024. You can see that gold is going up because of it, or at the same time as that. So now we're in a situation where the Fed is going to cut first into rising prices for goods and services, and they're going to cut into a rising price for gold. That was not the situation at all in 1980. People who say you can't compare to 1980, this isn't the case. I agree with you that you shouldn't use those ratios. This is going to be a lot worse for the dollar, and it's going to be the end of it because the debt is so much bigger now. In 1980, they were cutting into a falling consumer price inflation situation, but now they will be cutting into a rising consumer price inflation climate. The Fed is decreasing rates when inflation is still rising, which is the opposite of what Volcker said. Since 2024, gold has broken out at the same time as rate cuts, which is a direct result of lower real rates. In the past, easing toward disinflation led to easy landings. Stagflation happens when the CPI slowly rises. Investors should keep in mind that real assets do well in that situation, but long-term bonds do poorly. The macro setting is worse than it was in 1980, because budgetary stress makes it hard to raise rates quickly, and inflation sticks around, which hurts confidence. Positioning defensively now is about protecting against more than just a cyclical slowdown. It's also about protecting against structural devaluation. Next, we'll talk about why this cycle keeps gold's gains. Unlike in 1980, and even though debt to GDP was substantially lower in 1980, it was still lower than it had been at any time since World War II, since the Great Depression. Now it is at its highest point ever. They can't do anything because of the enormous debt they have to cut into rising prices for goods and services. It's 1980. That wasn't necessary for them. That's why they kept the dollar, and that's why they won't this time. Forget about the Hunt brothers now. The finish of the game is near. It will be here soon. And this time will be considerably worse for people who own dollars, and much better for people who own gold and silver, because the gains of 1980 will be held and surpassed. This warning is really serious. There isn't enough money left to save the currency like there was in 1980. The Fed can't tighten without creating default-level stress, since debt to GDP is at an all-time high. That makes the policy line up with the worst possible outcome. Cuts in rates lead to inflation and the loss of value in assets. For people who save money, this means that cash is structurally damaged. While gold, silver, and some commodities are likely to keep and grow in value, the Hunt brothers and the silver squeeze were only a sideshow. The imbalance is now built into the system. The end game is less about guessing and more about keeping buying power alive. Next, we'll look at how these changes affect currencies around the world.